Chapter 6: Creation and Transfer of Deposits. What is a bank deposit? A simple question, isn't it? Anyone can answer it. Unfortunately, most people will answer it incorrectly, or, at best, inexactly. If, without reading further, you can accurately define bank deposits, you are the exception. There is a persistent confusion respecting deposits. 1. Deposits are our most important money, yet to the bank, the deposits of its customers are not money at all. You take a handful of currency to the bank and deposit it. However, under no circumstances whatever do the bank's deposit consist of currency. 3. Most people suppose that a bank lends the deposit of its customers. In fact, however, no bank ever lends its deposits. These apparent contradictions result from the fact that we regularly use the word deposit in two entirely different and completely inconsistent ways. Ambiguity is inevitable unless we clearly specify which meaning the word is to have. We cannot possibly, in an analysis of bank operations, follow the common practice of allowing deposit to mean one thing one moment, something entirely different a moment later. Specifically, we must decide whether we are going to consider a deposit as being the thing that is turned into the bank, the actual checks on the other bank, and pieces of silver and currency, or as being the sums owed to depositors. These two things are not the same at all, for one is an asset, the other is liability of the bank. Logically, perhaps the term deposit should refer to the physical asset that one surrenders to the bank. There is no difficulty in understanding what has taken place if we say someone deposited $50 of currency or made a deposit of $300. The customer turned in that amount to the bank, and the word is used in accordance with the first definition. But then we say the customer has deposited $300. The customer has a deposit of $300. And we have swung over to the second definition. The deposit is an asset of the customer. It cannot possibly be at the same time an asset of the bank. Exactly what is the customer's deposit asset? Certainly it is not the handful of currency or the check the customer turned over to the bank teller, for these are now assets of the bank. The assets of the customer received in exchange was a claim on the bank. From the bank's point of view, this deposit, as such, is a liability. When the bank increases its assets, currency, checks, and other negotiable instruments, it increases its liabilities by an equal amount, or sometimes it says here the full document is available upon request. It says page 5 states, money is anything generally accepted medium of exchange, not simply coin and paper currency. Money doesn't have to be intrinsically valuable in itself, be issued by a government, or be in any specific form. Demand deposits are the nation's most common form of money, comprising about 3/4 of all money in circulation. Page 7 states, but that approval doesn't make cash any more real than checkbooks balances. Page 19 states, checkbook money is created by currency deposits. Commercial banks create checkbook money whenever they grant a loan, simply by adding new deposit dollars to account on their books in exchange for a borrower's IOU. So when the borrower gives a promissory note in exchange for deposits, dollars, which is a debt, a public debt. U.S. Department of Health, Education and Welfare, National Institution of Education. This document has been reproduced exactly as received from the person or obligation originating. Its point of view on opinions stated do not necessarily represent official National Institute of Education. Okay, let's see, what is it saying? The education. Let's see. I bet. So this is from I Bet You Taught by the Federal Reserve Bank of New York, Part 7. The Fraud of Banks. The Fraud of Bank Loans by Mark Allen Wasmuth. If you guys are interested in reading this, reach out to me. I can send it to you through email. Money is simply coin and paper currency. Money is any generally accepted medium of exchange, not simply coin and paper currency. Money doesn't have to be intrinsically value in itself, be issued by a government, or be in any specific form. In our past, items ranging from iron, nails, and dried codfish to gunpowder and tobacco has served as money. Anything people generally accept in exchange for items of value is money. Money also is a standard of measuring value and a means of storing purchasing power for future use. Any item has that has these three traits is money. Americans accept three types of money: coin issued by the Treasury, paper currency issued by the Federal Bank Reserves, and checkbook balances, demand deposit at banks. In analyzing economic activity, many economists take a much broader view of money and include other money like items immediately available to the public for spending, such as passbook savings and other funds deposited for specific time periods. Demand deposits are the nation's most common form of money. That means it's the deposits that go in public bank accounts, comprising about 3/4 of all money in circulation. This checkbook money is bookkeeping money, created mainly by the nation's commercial banks. Americans prefer using checkbook money because it forms money mainly. Where is it? America prefer using check because it performs as a more efficient medium of exchange than coin or currency for many transactions. Check writers have with one blank check the potential for spending small or large amounts, since each check must be signed before funds are transferred. Checkbook money cannot easily be stolen. In addition, canceled checks provide written proof of payments. Since we prize convenience, safety, and record keeping, it's no wonder that checkbook money is preferred. Checkbook money works because people are confident in the strength, safety, and prudence of the American banking system. Their confidence has been hoisted by government regulations of commercial banks and government deposit insurance. The check clearing and collection system of the Federal Reserve, the nation's central bank, has also made checkbook money highly acceptable by speeding checking account transfers nationwide. We've been big check users for quite a while. The move began in the post-Civil War era, when bank deposits became the dominant form of money held. Today, if all payment transactions were counted, including those for stock, bonds, and real estate purchases, the dollar volume of check spending to coin paper currency spending would be enormous. Only about 3% of our money is in coins, and for every 10 cents in small change we keep, we hold about $1 in paper money. As a nation, we hold only about 80 billion of cash, compared with 280 billion of checkbook money. Isn't that interesting? I Bet You Taught by Federal Reserve Bank of New York. The Fraud of Bank Loans by Mark Wasmuth. Only coin and currency are real money because the government says they're legal tender. Coin and currency are legal tender. Wait a minute. Only coin and currency are real money because the government says they're legal tender. Coin and currency are legal tender. Money, the government says, has to be accepted if offered to settle a debt. But that approval doesn't make cash any more real than checkbook balances. Until the 1860s, legal tender applied only to coin, yet even then we used more private bank notes and bank deposits as money than coin's legal tender designation was given to certain government-issued paper currency during the Civil War to win public confidence in the paper money. However, there has been no meaningful distinction between legal tender and other U.S. money since 1933, when Congress made all coins and currencies legal tender for all public and private debts. Regardless of what any government says, money must have certain characteristics that make it acceptable. Without those traits, even legal tender cannot be successful as money. Most early monies were not issued by governments. They were commodities such as salt, cattle, and rum that were widely known and easily sold or used. But commodities proved less than perfect monies. The tobacco used by the early Virginia settlers is an example. The leaves weren't easily divisible, causing difficulty in making change. The varying prices for different grades of tobacco made value difficult to determine. It also was hard to carry and store. Temperature and humidity changes caused flaking, which devalued the leaves. In short, tobacco lacked many characteristics needed to make it work well as money. For an item to perform successfully as money, it must be durable, divisible, portable, and difficult to counterfeit. More important, as the Virginians' experience shows, while any item can serve as money, it won't work well or last long unless it can also serve well as a standard and store for value. People's willingness to accept money on any form is rooted not in the law but in money's ability to effectively measure and hold value. Guys, if you like this and you want to read more, you want to read this personally, this document again is called I Bet You Taught. The Fraud of Banks Loans by Mark Allen Wasper. All credit goes to the author. I am simply reading this for myself and sharing it because maybe you don't have time to read it, or maybe you're not convinced in reading it yet fully, so this is a preview to help maybe inspire you to want to read it. Thank you for watching, listening, and joining, and I hope you share and give it a like.